Hello, everybody. Welcome to Friday. The S&P 500 was up 0.6% today. I don't have my normal Talk Money with Tom show, but I'm still going to do just a quick summary on what I saw happening with the market today, this week. And so really, this week was very fascinating in that, of course, we had a down week, but you have to take a look at what was going on here. We have fairly light volume, so it doesn't take much to move the market one way or another. And at the end of this quarter, we have this large rebalancing happening amongst these pensions and target date funds. According to Bloomberg, that's going to be $100 billion worth of stock that are sold here at the end of the quarter. We saw a big drop at the end of the third quarter that happened again during that rebalancing timeframe, the last couple of weeks of September, and then the market just kind of took off right after that. So we're seeing another drop here at the end of this quarter. Not too surprising with that type of money being rebalanced. Also, we heard from Bank of America today that $48 billion worth of money was pulled out of stock, bond, and stock mutual funds and ETFs just this week alone. And so what people are doing is they're taking those out to capture their losses. So both of these, the rebalancing and the loss capture, are temporary. So we have to be very careful not to overreact to these downturns that are happening here, like you would have done, say, at the end of September, because the fourth quarter turned out to be a positive quarter altogether for the stock market. And so we want to wait and see how this is going to play out and see what happens in the first quarter of next year, where I think the more important thing will be earnings and how a possible recession or these higher interest rates might impact earnings. We did get some earnings reports this week from Nike and Federal Express, which were good. Market responded positively to that. And some poor earnings reports from Micron, for example, semiconductor company that really drove the market down because of that. So I think going forward, looking at that first quarter, we're going to have the same type of thing. We have this big shift of money from goods that we could buy, during the pandemic to services, which we can now do because we're kind of getting out there a bit more. And I think a lot of times the market seems to be looking at these things like Micron, oh, they're not doing as well, we're going to have a severe recession. And what they're really kind of maybe missing, in my opinion, is the fact that we're in a pandemic and we're really shifting from one area that we could spend money on to another area. And so I think that's going to be the ongoing piece that we have to deal with in that first quarter as far as that goes. We still have a strong labor market. We saw first-time unemployment claims come out this week that were better than expected. And so that continues to show some strength, and we'll see how that holds up. And maybe that allows us to have a shallower recession and less impact on earnings. But really, that's going to be the big story of next year. What does the Federal Reserve do with this inflation data? We saw the PCE, which is the favored inflation index for the Federal Reserve, come out today. Core inflation on PCE was 4.7%, was 5% the month prior. That's a nice drop. It's continuing to come down. The Federal Reserve is talking about getting down to 2%. They're talking about core PCE. So they got to go from 4.7 down to 2. So it's getting closer, still a ways to go. But I think inflation is going in the right direction. And you can see that in the different bond market motions altogether for the last month or 6 weeks or so. The big focus will be really on recession and how these things play out and what the Federal Reserve does. And so one of the fears the market has since the last Federal Reserve meeting is they talked super aggressively about how long they were going to keep up rates and how much they were going to have rates up. I wouldn't put personally a lot of emphasis on that as far as what they're saying, because so far what they've said and what they ended up doing, if you look backwards, and look, what happened, what did they say a year ago versus what they're doing now? The complete disconnect. They're absolutely wrong as to what they thought they were going to do. I pay more attention to what the bond market is showing that they will be doing, because that's been much more accurate. And so right now it's showing that we're looking at maybe the top of the rates coming very quickly here, and not much increase past that. So, if they continue in their own, maneuvers to go higher and higher and higher, we have to watch what the Federal Reserve does, because they could cause a severe recession just by going too far. So that'll be what we watch next year as far as that goes. But I do think the Fed will respond to the data as it comes through and start to moderate their increases, maybe even moderate their rhetoric at some point in time. And hopefully let the market do what it needs to do as far as that goes. So have a great holidays, great Christmas coming up here. I look forward to talking to you next Tuesday. Markets close next Monday. So look forward to talking to you then. Thank you very much.